We are back. Flamingo Property Investing, Mr. Spears, looking as sharp as ever.
Thank you, mate. Trying.
Mate, you're a seasoned guest now on the podcast.
Yeah, third time, mate. Good to be back.
You look good, you feel good, the energy's good, and today we are talking what you know best, which is the commercial landscape. I've been creating a lot of content in recent times about how building a property portfolio is not just about acquiring a lot of assets and not having any goal in mind. We have a very strict philosophy where we use the front end of our journey to build our wealth using residential due to the leverage you're able to get, and the back end of our journey to be able to transition the capital that we've created or the equity that we've created into something that's going to be producing us income. We choose commercial real estate for our asset of choice. And today we're going to talk about how that transition works, the different lending options out there. We'll go through some actual case studies or real life examples that we've been working on recently to be able to show the power of commercial real estate and commercial lending if you use it correctly.
Perfect.
So first thing I want to run through is obviously the commercial lending landscape, residential lending landscape, slightly different.
It is very different. Yes.
Yeah. Would you say the commercial lending landscape is looked at more through a common sense approach, maybe like a business, as opposed to how residential lending is sort of blanket approach to your mum and dad's, right?
It is. It's got different sets of regulation, which is probably the key thing.
Right.
So in terms of, I guess, the checks and balances that you do with both application types, they're similar, but there's different levels of regulation on resi than there is to commercial. So in terms of those deals which might be, I guess, a bit borderline and not actually hit in the residential space, commercial is a lot more commercial in that respect, where you can get more things done if there is some common sense there, and we can sell that to credit.
I know from a recent deal that I'm doing at the moment for a personal scenario with the wedding venue that we bought, like the way that they looked at that deal as opposed to a residential lender, very, very different. For example, valuation come in less than what we paid for the property because it's a very unique property, hard to value. Now, in residential land, if a valuation come in, whatever it come in, $1.3 million under, they'd be asking you for $1.3 million worth of security or capital to be able to top that up. Where what we found in the commercial land is instead of having to put in that $1.3 million of capacity, was it a GSA over the business?
Yeah, GSA, that's right, the old fixed and floating charge. Yeah,
that's right. And essentially what that means is the lender has the capacity to be able to see the cash flows coming through the business to be able to support that, and they use the business valuation or the security of the business to top that loan up. So we didn't have to put in any extra money.
Correct. And I guess if you look at that scenario in residential, if you had a pre-approval with a bank, you went and bought a property at auction and you got a valuation that was 200 grand less and you wanted to complete on that property and you didn't have the cash to cover that shortfall, you've got to go to another bank and do a whole new application and start again. So I guess the flexibility you get with commercial is just like, you did with your bank, was look outside just the asset and go, hang on, we've got a business here. We're actually happy to extend some value against the business to help us bridge that shortfall and get what we need. And
not have to put in any extra capital and still relatively competitive in terms of what the rate is, what the terms are, which is unique. So the evolution phase of the journey for us is you've built some wealth in your residential space. If most people who would have bought residential real estate in the last 5 to 10 years would have a significant amount of equity. Generally, though, the rental growth of a residential asset doesn't keep up with the capital growth, right? So you could have a $2 million residential asset today that you bought it for $1 million. It's probably renting for $900 a week, give or take, but it's worth $2 million. So you look at the yield on the value of the asset, very slim. But if you reinvested that $1 million of capital you have in that property into something else, it could produce you $50,000, $60,000, $70,000 a year of net income. So it's probably less about not having enough capital to be able to do it and more about being in not the right asset class.
Yeah, correct. And I think it's about, again, planning ahead and understanding, where is my servicing limit? Because if we want to get access to that money, we need to do that before we hit that servicing wall. So, I love commercial. We do a lot of it. It makes a lot of sense for our clients that really want to get up the deal curve and increase their yields on their portfolio. But you just got to make sure you don't leave it too late. Because if you've done a lot of great work to buy some really great foundational assets and they've grown, want to make sure that you're going to leave us that headroom to get that equity to be able to pivot if the time is right.
And if you don't have the capacity to refinance the equity out, you could potentially sell the assets down and realise the capital through a sale.
Absolutely.
Let's run through the deal or the client we're working on at the moment, which is a unique scenario. And again, if they just went traditional bank, which is what he wanted to do originally, wanted to buy a residential asset, Very different scenario to what could happen in commercial land. So let's talk through that. Young guy had $1 million cash or thereabouts.
Correct. Yeah, thereabouts.
But little to no income at the moment due to what's happening in life. So let's assess that. How do we assess that deal? What would it look like in residential versus what would it look like in commercial land?
Yeah, look, it was an interesting one because there was no income today, and I guess the initial conversation was around residential. Hey, I've got this money coming in, I've got a property, it's been sold. I'd like to get back into the market because the asset I sold I don't think was going to perform historically the way it did.
Yeah.
So we had a good chat, and really the outcome of that was it is pretty black and white in the residential space. If you're a PAYG applicant and you don't have a business and you don't have income coming in, the bank's unable to lend for the most part.
Yeah.
So
that's a fascinating thing. Just zooming in on that. If $1 million of cash, right, to a bank, it's a lot of security. But if you don't have any income, they don't care how much cash you have. It's black and white. Unlikely to lend you any money.
Correct. If you're getting a $5,000 credit card or you want a $10 million loan, the process is the same. It's great to have cash and it's great to have assets, but without income, you can't do anything.
It's serviceability, right? So no borrowing capacity in the residential world, but still the $1 million worth of cash. So what were the other options and what do we end up landing on?
Yeah, so we looked to really talk about why we wanting to invest, and income was something that kept coming up for this individual, and we said, well, look, commercial property is definitely an option. Why don't we have a look and see what type of policies we can use, trying to leverage that cash to actually get some lending from the bank. And there's two ways that you can do serviceability for a commercial application. There's what we call full doc, where we're using all income generated and all liabilities, or this lease doc. And for this individual, lease doc was perfect. So what we did is we said, okay, well, if we're going to use this portion of cash, because you want to keep this cash to the side as a bit of a buffer, we can potentially lend you up to 1.625, or sorry, you could potentially buy 1.625 worth of assets, and we can lend you $1 million to do that. So by leveraging that 600K deposit plus about 100K stamps, we're able to put 700 grand into an asset and get a property for 1.6 mil with $1 million worth of debt that we couldn't
borrow
get
$1 million as opposed to borrow $0.
Correct.
Going through residential.
Correct.
Which is a huge difference and will make millions and millions and millions and millions of dollars of difference down the track with leverage and growth on that asset.
For sure.
So let's run through how that works. So you said full doc loan is essentially, I come to you, I've got my cash, I give you all of my documentation, and they assess the application. So what would have been the difference between doing a full doc commercial application and a lease doc commercial application? Would there have been many differences with the outcome?
There would have been, because we would have had to take into consideration any, say, HECS, credit cards, any type of liabilities of a business or a personal nature in a full doc application. But when we're looking at lease doc, we're essentially looking at the transaction ring fenced. So what I mean by that is we're just looking at the asset we're buying, the income that asset is generating, and then the debt that we can actually support off the back of that asset as well.
Right. So essentially the property itself covering its expenses up to a certain point.
Exactly right. And the way I guess we worked it out was, if we're going to buy this property for 1.6, let's say it's getting a 6% net return. I think it was 1,625. That got us about $97,000 worth of income, net income, because tenant pays the outgoings and everything like that.
That's another very important thing. The vast difference between residential and commercial, right? You could get $97,000 of income in residential land, but out of that 97, property management fees, council rates, land tax potentially, and all these other expenses. So your net rental income might be $40,000 a year.
Correct.
Where in commercial land, you get $97,500. Your only cost, generally speaking, is cost of debt.
Correct. So you're getting a true net, which is brilliant, which you don't get in resi.
So your income, your actual income, significantly higher. So the bank uses the $97,500.
$97,500, and we go, okay, well, how much debt can we actually cover with this $97,500? So we looked at, I guess, the banks we could work with and the policies, and every bank's policy is a little bit different. But essentially, the rough test for anybody at home is that the bank want to see you cover at least 1.5 times the interest cost.
Right.
So what we looked at, we often reverse engineer the position to go, okay, well, this is, I guess, the cash we've got, this is the potential deposit, this is the potential purchase price, this is the potential yields of where we're looking to actually buy. And then we go, okay, well, if this is the net return that we're going to get off an asset at this level, what is, I guess, that's 1.5 times of, coverage. So we need to go, okay, well, 97,500, we can cover 1.5 times is $65,000 worth of interest costs. So if
Right.
we're going to take $1 million worth of debt on at a 6.5% interest rate, we come in at a 1.5 times interest coverage ratio. So ICR, which is what the banks look to cover.
And that's how they work out, well, you can borrow $1 million based on that 97,500 of income.
Exactly.
And it's an actual assessed 6.5% interest rate, not an assessed plus 3% buffer.
There's no 3% buffer. There may be buffers with the different banks depending on what they're looking to do, but for the most part, the best way to start is go, okay, can we cover the debt at 1.5 times on our net rent?
Right.
Yeah.
So, which is, again, very, very powerful. And it made $1 million of difference between being able to not borrow any money and obviously being able to borrow $1 million and buy something at a $1.6 million valuation. And the real power here is, like, if this individual had, say, the $1 million in cash, they're using, say, 600 to 700 of that, not the whole 1 million, and they're able to buy an asset at, 1.7 million bucks.
Yeah, correct. They could keep that cash to potentially renovate the asset to increase value, increase the net lettable space, which could increase the rent that they're going to get from that property. And as we know with commercial, the rent is intrinsically linked to the value. So if you're looking to manufacture some equity, different to residential, where I guess you're looking at direct comparisons and what else is sold, that applies in commercial, but if you can directly increase the rent, there's going to be a direct uplift in the value as well.
Which is incredible. And this is why we use this strategy as people get towards the back end of their journeys, right? Because most people through their life, when they're growing their wealth, they grow it in residential. Very few people, more sophisticated investors maybe, but very few everyday people grow their wealth in commercial assets. And people get to the back end of their journey and they've generally got lots and lots of equity, whether it's in their owner-occupier home, whether it's in their residential assets that they've owned for 30 years and paid down to zero. But because the rental yields on those properties are so low, you could have $5 million worth of net assets and be getting 100 grand, 80 grand worth of income. Then you get a big land tax bill at the end of the year because the land value of those assets is, significantly higher than when you bought it, and there's actually no income. But that's the term asset rich, catch poor. So if for example someone was in their 50s, wanting to either stop working inside of their business very soon or stop working in their job, and they've got all of this capital, essentially they could sell down their residential assets, unfortunately pay the tax man a chunk of tax, and come out with a couple of $1 million worth of assets, not necessarily need to have any income to show, and still go and borrow money at, say, a 60 to 70% LVR if you're getting that 1.5 times coverage.
Correct. And I guess, if you're getting those yields, and let's just say you sold your resi portfolio and you took out $2 million. Even if you were to buy, I guess, $2 million worth of commercial property at a 6% return, that's 120 grand of income straight up. So, for most individuals, that's going to probably carry them through this, their retirement quite comfortably. But if we were to leverage that and potentially go up the deal curve to, a $4 or $4.5 million property,
which would essentially be only leveraging 50 or 60%, right?
Correct.
You're putting in 50, you're borrowing 50.
We're still getting net income.
6% on the 4 million, right? So instead of it being 120 of income, you're now getting 240 of income.
Exactly. So we've got some debt costs to cover, but we're still getting probably a better quality asset in a better area with probably more blue chip tenants. And I guess that's one thing people can be a little bit scared about, the tenant risk of commercial. But if you buy well and you do your research and you've got the right leases in place, you can mitigate a lot of those risks and avoid those vacancy periods as well. 100%.
And we'll have a proper episode on how we select assets to have the lowest possible risk. But the other power in that is, let's say that you are preparing now to stop working or within the next 10 years you want to stop. If you go through this transition period, and let's say that you buy something for 2 million, 3 million, 4 million, you put in 50%, the bank puts in the other 50, or the bank puts in 60, you put in 40. If you've still got then say another 5 years left of work, the income that asset is producing could then also go to paying down the debt on that property. So every year you're paying down 120 or 130 of debt, because that's the net income that it's spinning off, which then means the following year it's spinning off more income, right? Because it's like this vicious cycle of spinning off income, using the income to decrease debt, spinning off more income, using it to decrease debt. So when you actually get to retirement, the income that it's producing is significantly higher.
Yeah, it's funny you say that. So that's a transition to retirement strategy that we talk about a lot with clients. We can't give them advice on that strategy, but from a lending standpoint, we talk about, well, this is what you can do in residential, this is what you can do in commercial. Now, with resi, we always do interest only, depending on what we're trying to do with that surplus cash flow.
Yeah.
But for commercial, if we're still working in our job and we're still earning income and we don't need that commercial income yet to live, then if the intention is to use that asset in our retirement to help fund our lifestyle or whatever it may be, then you're right, putting that money straight back into the debt is a great way to do it, because we're only enhancing the yield on a higher yielding property versus those other properties in our portfolio.
Exactly. And can you get offset accounts with commercial properties or commercial debt?
Some banks you can, but most loans you can get redraw in them, so you are going to get a similar outcome. And because you're generally in a company entity rather than an individual entity, it's not so much of an impact using redraw as opposed to offset for a company than it is for an individual.
And why is that?
So with an individual, I guess you're protecting the initial use of that debt. So deductibility from the ATO is driven by the use of the debt rather than the security or the product type. So if we were to pay down a residential asset and then we redrew it to buy a car, then part of that loan now is used to buy a car, not to buy that original investment property. Where in commercial, it's a different set of rules. And I guess with business owners in general, it's a different set of rules where you're expensing that interest in a company P&L. So the government isn't, the accountant isn't so much concerned about what that debt was used for, because that debt's held within a company. So it's got a different outcome.
So just in general, the interest, regardless of what it's used for, or what it's used for a company expense, is deductible.
Correct. And that's the advice we've had from accountants as well.
So generally speaking, this is another really good thing that we can cover off. If we're going through that transition period, they've built the wealth that we're talking about, they've got the capital to be able to invest in commercial. How important is structuring from the clients that you've worked with, right? Because if you go and put a commercial asset in your personal name, for example, and it starts spitting off 150, 200, 250,000, and the income is increasing as well over time, right? Because that's what happens. You have your rental increases built in. You're in a personal tax environment then, right? Which essentially means that you'll be paying a pretty penny in tax, where if you're in a certain structure, you generally can be more tax effective and potentially have the ability to distribute as well.
100%. I guess the key thing with the lease stock facilities, it does need to be in a company name. That's one of the key, I guess, policy requirements, because if it's in your individual name, the bank, I guess, still needs to apply some of that regulation that they do in the resi world. Where if it's in your entity's name or your trust name, whatever it may be, they're able to apply those policies. And again, having that in there, as that income grows, like you said, you can distribute, and it's just going to make your tax planning a lot more effective. Right.
So it's actually a policy that you need to have it inside of an entity to take advantage of that type of lending.
Correct.
That's very, very interesting. And generally, is there a better structure than another? Not from a taxation point of view, but from when you're putting it towards a bank? Like, do they like it in a company, or do they like it in a trust, or do they have no preference to either?
There's no preference. We can make either work. I guess the probably benefit of doing one over the other is a taxation and a legal conversation. As long as we've got a PTY LTD, either company or trustee of a trust, we can make that work.
And let's talk about, they've got the property, they've done the transition, they've got their first commercial asset, starting to pay itself down, and we've got like a 10-year runway. What's the then capacity to be able to leverage off that commercial asset to potentially go buy another commercial asset? I know in residential land, every couple of months, really, you could get a new valuation and hopefully get an updated equity position. And if you've got the capacity, you can pull that equity out and go and, rebuy or use it for something else. What's it look like in commercial land from your point of view?
Yeah, look, it's similar, but it's more cost prohibitive than it is with resi. You can go to your broker and get a resi val. It doesn't cost you a thing with most banks, and you can generally do that every 3 months, depending on the lender. Commercial, every time you do a valuation, it's probably going to cost you between 3 to 20 grand, depending on the asset. And bank is only going to look at those valuations for probably 3 to 6 months, depending on the asset type. If it's a specialized commercial asset, it may be shorter. If it's an industrial asset, which is the predominant type of lending the bank do, it could be a longer term.
Right. And have you seen increase in valuations in short periods of time? Because if a lot of the value of an asset is intrinsically tied to the rental income or the lease inside of that asset, if you're not doing anything to increase the rental income and they're locked into, say, a 3 or a 5 year lease, how do we get an increase in valuation if the lease is only going to increase by maybe 3 or 4% per annum?
Yeah, so in terms of the process to get the valuation, again, we just engage a valuer, but in terms of the driver of getting that equity uplift, it's going to be the rental increases. It's going to be actually increasing that net lettable area to be lent on your property. I've got an example of a client where they came to me after they bought a property. They bought it and it was vacant. So they bought a vacant property and they needed a lease stock facility.
What sort of asset was it?
So it was an industrial asset in Sydney. So bought the asset. It was vacant possession, so there was no tenant in there. We needed a lease stock facility for this to work, but this applicant knew that. So what he did is he got a long settlement period, bought the asset unencumbered, put down the deposit, so didn't actually physically own it, but negotiated to actually get into the asset to renovate it. So renovated it for about 6 weeks, put it on the market to advertise for rent. Got a tenant in there, got a tenant at a higher rental because he was able to do a lot of the renovations that he wanted to make the space a little bit bigger, make it a little bit more palatable. So I think we bought that asset for 2.5. When we got the tenant in there with the lease, when we actually got that valued up compared to the other assets on the market, the value of the asset was actually 3.2.
Right. So 700,000 more than what he paid for it.
$700,000 within the space of 3-4 months. We settled on a property at the high valuation amount, so we were able to negotiate that with the bank. So there was an instant equity uplift of 700,000, which actually compressed the amount of cash he had to put into that transaction.
And the real value there come from buying something vacant possession, which generally, if you didn't have the capital to be able to pay cash for it, or the majority in cash, you wouldn't be able to get debt on one of those assets, right?
Correct.
Because banks are scared to lend on vacant commercial assets. So he bought it, got a long settlement on that, and then between when he exchanged and when he settled, increased the value of the asset by renovating it and getting a tenant that wasn't in there previous.
Correct. And I guess that strategy comes with a fair bit of risk, because if that didn't all line up, he would have been entered into a contract and been asked to, cough up the money at the end of the term. So he knew that going into that, and he was able to execute on that plan. But even buying a property that has a tenant in there that's, I guess, under market rent. So we know that, hey, this has got a lease for 2 years, but this rent is actually 20% below where the market is. So if we actually buy this asset now, yes, we're not really happy with that return, but we know that once it comes up for renewal, we've got a rent review clause. We can actually do some renovations to this property potentially along the way, depending on the tenant's buy-in. And then you can actually increase the rent on the tenant with that market review, complete evaluation, and you should have a higher outcome that you can then leverage against and potentially go again.
So how would you work out, or how do the banks generally work out what a asset should be trading at in terms of yield? So hypothetically speaking, if the assets in the area are generally all trading at a 6% net yield, and when you buy the asset, you're buying it at a 4% net yield, how can you be confident that the rental increase will be X to Y, and based on that increase, the new value would be whatever it is?
So I guess all banks will take the valuation as the source of truth around value.
Right.
So the biggest piece of the puzzle for a commercial application, especially in a lease stock application, is the valuation. So the bank will look at that and say, okay, we've got a third-party valuer that's gone out and done the work for us. They've looked at all the direct comparisons. They've looked at the rent per square metre of these kind of assets within this area, and they've arrived at this valuation amount. So the bank isn't, I guess, concerned about what you pay for it. They're more concerned about what does the valuation say and what does that deem the value. What have you actually bought this asset for? Does that align? And if it doesn't, do you have the cash to actually cover that shortfall?
Right. So the value dictates what the property should be worth based on how much it is leasing for per square metre, or what it should be leasing for
100%,
per square metre.
100%. And I think the savvy investors, or investors working with a buyer's agent, are going to look at that asset and go, hey, we know that the rent per square metre on this asset is below comparables. We know what everything else is renting. We know what other things have sold within this area. We see value here, but we're probably not going to be able to realise that value until 2-3 years when that lease looks to expire. So you're not going to get it instantly, but you're pretty confident that when you're able to increase that rent, and there's going to be CPI that happens along the way, because commercial leases have CPI built in for the most part.
Which in layman's terms is essentially whatever inflation is for that year, generally your lease or your tenant will have to keep up with inflation.
Correct.
So a lot of people felt the real positive effects of inflation in commercial real estate over the last 24 to 36 months, when inflation was 6, 7, 8%.
Yeah.
That's, their increases were pegged to CPI, which then meant their increases were 5, 6, 7%, which dramatically increased the value of assets, especially if you're used to like a 2 or 3% CPI increase, right?
100%. And I think that was a change that some savvy, I guess, leasing agents and clients did when they're doing their lease renewals. They changed it from a fixed CPI increase of 3 to 4%, which is quite standard, to a market linked CPI increase. So we've just gone through a big inflationary period where CPI was as high as 6%. So those individuals were having their lease increased by 6% each year because
which
it's
is
linked
double
to
what it
CPI.
should have been increased by if it was pegged to say 2 or 3%.
Exactly.
Which again, power in that. But on the flip side of that, if it was negative or it was zero, which we've seen in previous years as well, hence the reason rates were so low, it would have had a negative effect.
Exactly.
So commercial is obviously for people who are, I think, a little bit more sophisticated, a little bit more savvy, and again are at the back end of their journey, generally speaking, because you do need more capital to get into it, right? Like with a lease stock, it sounds like you need 40-ish plus % as a deposit plus your costs. Let's talk about if you were to have good income and you were to go down the full doc route, what we're talking about, loan to value ratios, generally speaking, and what do they want to see?
So look, it depends on the amount, but we can get LVRs up to 80% for commercial as well.
Which is similar to resi, right?
Yeah, very similar to resi, and there's no LMI in the commercial space. So it really depends on the bank's policy, and that's dictated by the asset class that we're talking about, whether it's industrial, office, retail, specialised. They all have different LVRs that apply. But there's some lenders for sub-$1 million properties where they can actually provide 80% LVR for investors, which is just going to allow you to put a smaller amount of cash in and still buy a great asset that's getting a great return.
And what about north of $1 million?
North of $1 million is probably averaging about 70%. Is where the banks like to play.
30%.
30% on average is what people need to put in.
Right. And then is there like a certain price point where it starts to go over where they want to see more than 30%? Like if we're talking, say, north of $5 million or north of $10 million. I know in resi land, obviously, the LVRs start to come down the higher you go generally for normal borrowers.
No, it's pretty solid at 70. So when you're getting past, $20, $30 million, then there could potentially start to be some requirements to have some amortization on some LVRs. So they may go to 75% and want you actually to pay that down to 65, 70 within a reasonable time period. But no, you don't have the restrictions that you do in resi in the commercial space. Right.
So commercial, I mean, the deal that you just mentioned with the person bought it 12 months terms or whatever it was, we've done something very, very similar with an office space in Newcastle. We've purchased the building, we've put it under option, we've got a 12-month term, we've actually occupied the whole building for a very cheap market rent, and we're going to lease out the top floor and the bottom floor, increase the rent of those levels. We're doing some minor renovations there now, and then the floor that we occupy will then obviously increase the yield as well, and then hopefully when we settle on that asset, we'll settle at an increased valuation on what we actually bought the asset for. And because we bought it under vacant possession, again, there really was no value to the majority of the marketplace, especially in the office sector as well, right? Because it's a choppy segment at the moment.
100%. And I think what you're doing when you're buying an asset in vacant possession is you're pushing a lot of people out of the market in terms of those investors who want to get into commercial property are more often not looking for a leased property. So if you've got the capacity,
investors, right?
Oh, investors, 100%. Yeah, absolutely. And I think if you've got the capacity to do that and you've got the right strategy, then you can pick up an asset for potentially, quite a hefty discount, and then you manufacture that growth, through the leases later on.
And what about when people hear the term, say, going concern? Because in commercial land, again, because it's looked at more like a business as opposed to a real estate transaction, there potentially is GST payable on the acquisition of purchases. How does that work in a lending environment?
So it's really probably a good example of this is a pub. Yep. So, a pub is, I guess it's generating its income through its activities, selling beer, pokies, accommodation, whatever it may be. So the bank takes a view of this asset is a going concern because we need to ensure that the business that occupies this asset is trading at a level that's going to be able to cover the debt that we're extending for them to buy this asset. Right. So an example, we did a pub recently where, we're able to get 65% LVR in an asset, and generally the banks like to play at 50-55% for these type of assets, but we could show serviceabilities there, we could show all the mitigants to be able to, back the sponsors that they know what they're doing and they've, been working in pubs for a long, long time. Yeah. So I guess providing the bank, the story and the mitigants and the supporting commentary to really give them comfort that, hey, we know you like to play here, but these are the applicants, this is the transaction, this is where we need to play, you can sometimes bend those barriers, which in the resi space, they're generally pretty fixed.
And no GST payable on that sale or purchase of the pub because it's sold as a going concern, right?
Correct.
Where if it was vacant, a lot of the time you have to pay GST on the sale.
Correct.
Right. When we sold our commercial site down in Paddington, it was the same thing. Like you want to try and sell it as a going concern as opposed to vacant possession, because then on the sale we have to pay GST.
That's right, and there's some, I guess there's some nuances around that, and that's where I guess the legal guys come in and do their bit. But 100%, you know, there's ways in which you can structure, I guess, sales or deals or acquisitions where, you know, you can have that work in your favour.
That's right.
You know, if you're able to secure a great price and get a GST refund, you know, Q1, happy days. You know, there's 10%. Thanks for coming.
So it's something that people need to be conscious of, because it's not like residential, right? Very rarely is there GST payable on residential or claimable on residential unless it's a development or something like that.
Correct.
In commercial it can be.
Correct. And I think that's why, you know, there's sometimes a bit of apprehension with commercial lending is it is a little bit different. You know, it can be a little bit scary for those that haven't dabbled in it before. But once you understand the basics, you know, you're able to really mitigate a lot of those risks. And again, that's where working with someone to be able to walk you through that is definitely key.
So let's just, before we wrap, let's break down that deal that we just spoke about with, just to show the cash flow. So let's use the 1.625 purchase price, 6% net rental yield, which is generating $97,500 a year in net rental income. A $1 million loan on that purchase, so there's $625,000 of cash in the deal. At a 6.5% rate, which is generating, or it's costing $65,000 a year. So essentially, there's $32,500 of net rental income coming off that $625,000 investment. Because remember, we're borrowing $1 million from the bank. It's not our $1 million we're putting in. So if we're only putting in $625,000 and we're getting $32,500, that's a 5% net return essentially on the cash invested.
Correct.
Now let's adversely put that into residential, no borrowing, $620,000 into a residential asset. Let's assume no debt, and we're getting a 5% rental yield on that, which would give us the same $32,500, whatever it is per year. But out of that $32,500, you've got your 7% property management fees, which would work out to be about $2,500 a year. So you're down to $30,000. You've probably got some repairs and maintenance on the building at say 1% of the property value, so another $6,000 a year. So you're down to $24,000. What else you got? Other costs, council rates, another $2,000 a year.
Insurance.
So like the difference is by taking on debt using a lease stock facility, you're getting $32,500 net rental income with a $620,000 investment versus putting it into residential with the no ability to get debt, having no debt to pay, but still having a much lower cost or income base because you've got all of these expenses that as the landlord you need to pay.
100%, and I think that's, you know, that's the benefit of the shift. You know, moving from resi to commercial. You still need to do resi in my view because that's giving you the equity to play. But once you get to a point where, you know, you're hitting servicing walls or caps, so you're looking to really change the mix of your portfolio, commercial is just such a powerful tool to really, you know, supercharge those yields. Because
it sounds like your net rental income between those two examples could be nearly 50-60%.
100%, yeah, absolutely.
Which when you start to compound that over millions and millions and millions of dollars worth of net equity makes a significant difference.
That's it. We go up the deal curve. You know, let's just say, you know, we bought a $16 million asset and we got $10 million worth of debt. It's going to be the same outcome, but we're going to have circa $300,000 of net cash flow coming out of that asset. Yes, we need to put a lot more money into it, but the parameters stay the same.
That's right. Incredible. Mate, any closing words?
No, I think anyone thinking about commercial and they've got some money, it's definitely an asset class worth exploring. It's not as scary as you think. And, you know, money at a bank account is earning, you know, what, 4.5% these days.
That's it.
Yes, there's less risk, but there's no capital growth on that asset,
That's right. And if you're earning 4% and inflation's 4%, you're really earning nothing.
Yeah, you get nothing. So
very true. Mate, we'll be back.
Thank you.
Thanks, Legend. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production.